How's your weather been, Louisa? Has it been good down there, over there?
I'm trying. I haven't looked out the window much today. I've had
Have
my
I
head
been
down all day
outside?
on deals. I know. I've had two big commercial deals. I've had my head down. I think it's been quite warm today, actually, in Sydney. Yeah, cold down there, no doubt, where you are.
It has been a little bit cold.
I
Yeah.
was supposed to be there. I was supposed to be there next week for 3 days, actually, but
Mm.
had to cancel.
And it's been about 17 or 18 degrees, something like that. But it gets down to like 8 or 9, I reckon,
Yeah,
at night.
I was there last June. I was in Adelaide last June. It was freezing. They have a leadership conference. It's like the top 30 brokers get invited down. It's really
Yeah,
nice.
very nice.
But I'm missing out this year.
Oh, that's no good. We're not missing
Right,
out.
okay, I reckon we should get started. And then, as I say, we're recording this anyway. So everybody that's registered and all my clients at Zippy Financial, I'll be letting them all see this anyway. But thank you for those of you that have turned up. 7 o'clock. I know everybody's always tired after work and everything, but it's the only real chance we get to run these education evenings. So we're running this for my clients at Zippy Financial, but we also have advertised this in some local Facebook groups and things. I'll just, are you going to skip to the next slide for us, Kerry?
Sure.
So this is Kerry. So I'll talk about me first and then I'll introduce you, Kerry. So Zippy Financial, for those of you that if there is anybody on that doesn't know who we are, we're a mortgage brokerage based on the northern beaches of Sydney. But we cover nationwide. So the team is sort of spread around and we do cover everywhere over Australia for mortgages and commercial finance and asset finance and all sorts of wonderful things. So I'm an ex operations manager for NAB. I set up my business 12 years ago. Been Australia Broker of the Year, I don't know, 3 or 4 times. New South Wales Broker of the Year, I don't know, 3 or 4 times. We've won things like customer service and things as well. So that's my introduction. We invited Karen onto the webinar tonight because we do like to provide education. A lot of clients come to us wanting to, buy property, whether it be unoccupied or investing, but especially around investing. It's like people don't know where to buy. They don't know where the right suburbs are, or they're scared of making mistakes, and then they'll not proceed because they are scared of making mistakes. And we heavily promote buyer's agents because we see the value in a buyer's agent. And so we invited Karen to come along this evening to share her knowledge and advice with you all. So Karen, I'll hand it over to you and you can introduce yourself.
Thank you. Hi everyone. I'm Karen. I'm based in South Australia. I have a buyer's agency called 28th Street Agency, but we are borderless property investors. So we do owner occupiers for people all over Australia, and we also do investments for people, self-managed super funds or normal investments. Our team has a combined 61 years of experience. Just in the last 12 months, we've bought $49 million worth of property, and 42,000 or just over or over 42,000 we have donated back in money and services to people that need it as well. So we are a certified B Corp. Most people don't know what that is. Patagonia, Who Gives a Crap, Stonewood Beer, Susan, the clothing brand, they're all B Corps. So what it means is I put profit and purpose in equal measures. So giving back and purpose is just as important to me as profit. We have won Best Property Buyers Agency 2026, 2026 Women's Empowerment Excellent Award, and 2026 Real Estate Agency of the Year. We donate 5% of our time to pro bono to help people that need it, that can't afford a buyer's agent services as well. So that's just a little bit about my company. So we see the value of strength in a partnership. Your success is our success. The more you succeed, the more you're going to come back and get another property or get another house. So, and we love helping people into their homes as well. So just whatever your goals and vision is, it warms our heart to help you achieve that. So as I said, we are we work across Australia, so there is an estate that we haven't purchased in as yet, and we purchase where the market, where the market is dictating at the moment. With each client, we contribute to Catherine House, which is a homeless shelter or a shelter for women, unhoused women in South Australia. So with every property that we purchase on behalf of someone, we donate a night stay to an unhoused woman. And we have an Empower Her initiative where we donate 5% of our time to supporting women in need. So I will give away my buyer service for free. I've helped 2 women into a house this year alone, and I'm about to start a third one. So yeah, that's about that. For those of you who don't know what a buyer's agent is, you might do or you might not do. Basically, think of me as a personal shopper for houses. I will go out, I will research the market, find out where your goals are, look to where to buy, and I work exclusively to you to find the property. So, as a seller has a dedicated real estate agent, you have a dedicated buyer's agent. So, going up against a real estate agent sometimes is like going to court unrepresented. Like they train in negotiation training for 2 hours every week, and the average person hasn't trained in negotiation training, so it's not part of their job. Every question that they ask you is sort of, they're trying to get information out of you, I guess. So we are there. So we're skilled negotiators. We do all the research. We have great relationships with the agents as well. So we can get access to stock that you're not getting. So we're just ensuring you get the best deal and saving you time, money, and stress. So that's what a buyer's agent does. So why we're here, common property buying mistakes and how to avoid them. So the first mistake probably everyone has is, well, not everyone, but some people have, is no strategy and they're flying blind. So people know that they want to buy an investment property and and that's all they want to do. They don't really know. They think, oh yeah, I'd like to buy it, near me, near my house, because I can drive past it. There's no strategy. There's no how long do they want to hold for? When do they want to get equity out again? They have none of those questions. So they just sort of go out and buy a house and sort of hope that it's going to do well, I guess. So the worst thing you can do is flying blind. So having a strategy, having some clear goals around what you want to buy, where you want to buy, how long you want to hold for is key. So when we have a client come to us, we'll ask, one, what's your budget? Two, how long do you want to hold for? Three, is this the first investment property of many? And if it is, when do you want to get your equity out? So when you want to get your equity out, you could be buying you could say, okay, well, I want to buy another one in 1 to 2 years, or I want to buy one in 3 years, or I want to buy one in 4 years. And depending on how you answer those 4 questions, will depend on where we buy in Australia. So then we'll do some research and buy. So there is three investment strategy types. So one, you're buying for capital growth, which is the main and the best one. Basically, you're focusing on getting so much growth that you can go again, and that's when you can get your equity out. If you don't know what equity is, it's the difference between the loan and what the property's worth. And the other strategy would be cash flow. So focusing on something that's like either neutral or positive cash flow. And there's also balance, which is a hybrid model targeting both stable growth and comfortable yields. It's harder to achieve a balanced one. It's sort of usually one or the other. A lot of people go for capital growth and then they'll add value, like to get the rental price up. They'll add a granny flat on, or they'll do improvements, or they'll buy in an area where there's 100K difference between a 3 bedroom and a 4 bedroom house. So they'll buy a house that they can convert a 4th bedroom. So there's different strategies and different ways that you can add yield, but capital growth is usually the main strategy that you want. There's another point here that you may need a combination of strategies as you build a portfolio. So if you might start off with capital growth, so then you can leverage off of that to get another one. But then the next one, you might have to do a cash flow stronger one because your borrowing capacity is cropped out. So having a stronger cash flow property will help you be able to achieve the next lend. But Louisa can go into some of that anyway. So As I mentioned before, beyond your backyard is smarter buying. So property markets move at different speeds, and your local area might not be the best investment. So a lot of people like, I just want to buy where I know and where I'm comfortable with. But we find growth markets across Australia, depending on those questions that I told you before, and we use data, over 105 data points that we look at to find out where to buy for you. So we buy in warm markets, lukewarm markets, warm into hot markets and hot markets. So depending on your strategy and what you need. And sometimes you can't afford to buy in your backyard. So I meet a lot of people that they might have only $500,000, and say if you lived in Adelaide, you couldn't buy anything for $500,000. So they're renting in Adelaide and they're buying in Melbourne, or they're buying in markets they can afford to, and growth markets, so then they can build up that equity in those markets. And so as we keep talking about that, this is timing the market. So this is a property clock. It's by Heron Todd White, and it comes out monthly. And a market will move around in a cycle as a clock moves in a cycle. So at the moment, you can see that Sydney, Bundaberg, Dubbo, Mount Gambier, and Toowoomba at the peak of the market. Starting to decline is Alice Springs, Burnie, Devonport, and Launceston, and Tasmania. Port Macquarie is approaching the bottom of the market, and at the bottom of the market is Byron Bay, Ipswich, Southern Highlands. Now, so say probably 8 months ago, Melbourne was in a declining market. Probably 4 months ago, 3 months ago, it was at the bottom of the market. And you can see Melbourne's already at the start of recovery. Now, over here, with all of these, you've got Adelaide, Brisbane, Toowoomba, Barossa Valley, Darwin, a bit of Perth in there, Mackay, a bit of Queensland. It's all sitting in the rising market. Now, some of these have been sitting in this rising market for a good year. And I think, personally, I think Adelaide's more, sitting at 11 o'clock, 10, 11 o'clock rather than where it's sitting. So say if you came to me and said, Karen, I want to buy I want equity out in 1 to 2 years, we'd sort of be looking at somewhere around the 10 to 11 o'clock market. Because that's moving really fast. If I want something I can get equity out in 4 years, I would be looking sort of in the Melbourne, Canberra, Central Coast, Geelong kind of market, because then that's got all this growth to reach the peak of the market. So you've got to really time where you want to buy. And this is not what we just look at and go, okay, I'll buy here. There's 105 different data points that we look at, but this is sort of a basic clock so you can get a general idea of where the markets are sitting in Australia. Not being fully ready to buy, when people ask, is now the right time to buy, they're always looking for validation from the media or assurance from lagging historical data. A reality check is the perfect day to buy does not exist on a calendar. True timing requires a strict 3-part alignment, which relates to readiness. The 3 phases to a flawless purchase is finance ready. So we don't work with anyone until they come to us pre-approved, because it's just too hard to negotiate on they're not going to take your offer seriously if you come in and go, oh, well, subject to finance, I don't have pre-approval. Because if they've got 2 or 3 offers on the table, they're not going to pick yours. They're going to pick the person that's got that pre-approval in place. So aligning your borrowing capacity, comfort zone, and cash. And I can't do my research until I know how much you can buy. Because even if you ask those questions like, Karen, I want to get equity out straight away, Karen, I want to hold for 7 years, I still can't search and do my parameter search until I know how much you can borrow and how much you can spend on a property. And the answers that I will get will change depending on your budget. So there's no point me doing any research until you know your borrowing capacity. The market ready, so using lead, micro, and macro market indicators, and I'll go through them in a minute. And property ready, vetting the exact physical asset, moving past the staging and checking for invisible structural risks. So over to you, Louisa.
Okay, so I said I would cover off a bit of the finance part of the evening. So 6 steps to get home loan ready. Build your deposit first of all. Now we do have, we've only got one product. There is 2% deposit, but it is 2% deposit with no lender's mortgage insurance. It's a new product. Yeah, it's a new product we've recently got, and I was one of 7 brokers given this product. That's the beauty about being an award-winning broker. Sometimes we get things that other people don't get. So 2% there, that is an owner-occupied, but generally, you're going to need 5% deposit. Obviously, if you don't want to pay LMI, 20% deposit. You're going to need 10% deposit for an investment property. If you're doing owner-occupied or whatever, you've no money at all. If you've got a nice mum and dad or family member, we might be able to do a family guarantee, a parental guarantee with 0 deposit. And the thing that the banks do look for, though, is that you demonstrate that you've saved the money yourself over a 3 to 6 month period. That's not all banks, because no 2 banks are the same, but generally they like to see that genuine savings. Check your credit file. So we do see people come about the few things that we've seen on the credit file. So you can just go and do a free check yourself, look, see how it's looking. But make sure that you pay everything on time, make sure everything's up to date. And if you have got any issues, try and resolve them before you come to apply for your mortgage. There's lots of companies out there do help you sort any sort of credit file issues. They're very good at arguing people's cases to clear actual debt that was there and there was no issue at all, but they're good at getting things cleared. So if you've got a problem, come and speak to us or point in the right direction to those people. Try and reduce things like your credit card limits. I mean, we always run people's numbers and say, don't bother about credit card limits for now, because we'll adjust them if we need to adjust them. But, if you've got like 5 cards with 20 grand limit on each, that's going to heavily impact your borrowing capacity, by hundreds of thousands. So, so have a look at your credit cards, what you need, what you not need. The banks don't like anything like the buy now, pay later sort of stuff, lay-by stuff. They don't like any of that. The credit team's thinking on those sort of things is that you're living beyond your means, and that's why you're having to go and use those facilities. So how are you going to afford a mortgage? Get things like your identification ready. Make sure you're going to have, up-to-date driver's license, passport, and everything. We're going to need to see income documents. So last few pay slips, PAYG summaries, up-to-date tax returns. We're going to be asking all about your assets and your liabilities. So have a look how much everything's worth. We need to know, the balances of your supers and all that type of thing. And avoid major financial changes. So, always makes me smile, this one. But don't change your job when you're just about to apply for a mortgage. And don't change your job after you've applied for your mortgage. If you change jobs, even when you're pre-approved, it will make a difference. So you need to keep in that job until you've settled your mortgage. Don't go taking out any new loans. And I have got on there car loans. The reason I've put the car loans separately is that is probably one of the biggest issues we have getting mortgages approved is the car loans. And it's well known that people buy a house and a car, usually within 6 months of each other. They have the new house and they have the new car. Buy the car after you've got the mortgage, not before you've got the mortgage. Car loans are a killer. So don't increase your credit card limits if you don't need to, and don't go buying lots of discretionary purchases because they do class in your living expenses now. Gone are the days where we used to take everything out that wasn't necessary. Now the banks look at everything, your Netflix, your cups of coffee, everything's in there in your living expenses. And you need to go and prepare your own realistic budget as well, because at the end of the day, we all live very differently. I live very differently to my family members and my neighbours. Some of us are big spenders, and some of us are really, really good with us money and live on a very low budget. So you need to look at your spending habits yourself, run your budget spreadsheet, or come and get one from us. We can give you one, and have a look yourself what you think you spend and what you think you can afford, because what you can afford isn't necessarily the same as what the bank think you can afford. And the last thing you want to do is overcommit to something, find interest rates rise, and then you can't pay your mortgage back. There's nothing worse than financial stress. I've been in this game over 30 years, so I've seen it all. But yeah, have a look at your budget and go and look at, what your council's going to be at the new property, what's the strata, the insurance, the maintenance costs. So make sure you take everything into account.
Cool. Thank you. So the next point is once your finances are securely locked down and then we basically would go away and we'd do the strategy in the market and suburb research. Most people, when they're sort of looking where to buy that's not using a buyer's agent, I guess, the trap of the lag indicators. So most new investors fail because they rely on historical data, media headlines, and 12-month media proscribe, charts. There might be, you listen to a podcast and it says, oh, we've been buying in Newcastle and et cetera, et cetera, et cetera. But they would have already bought in Newcastle for the last 12 months or the last 6 months, and you finding that new area, they're not going to be telling you a new area that they're trying to get into unless it's old data, if that makes sense. So yeah, relying on the media and headlines to look at where you buy is not a great idea. Yeah, so as I said, yeah, the lag data only tells you what already happened. By the time the suburb is labelled a hotspot in the news, you're likely to buy and miss buy it as absolute peak. So we like to buy the warm spots, not the hot spots. Basically, being generally market ready means ignoring public hype, shifting your focus from backwards looking statistics to forward looking metrics. And these are the key indicators that we track. There is 105 of them. So obviously I didn't want to list 105 here, but we've got days on market. So our property's selling faster this month than last. Signals a rising buyer's urgency. So if the days on market are decreasing, that means that it's warming up to becoming a hotspot. If it's something like 30 days or under, that's telling you we're in a hotspot sort of thing. So it means that the day it goes on sale, 30 days later, it's already settled and got done. So it's, one first open done. Basically, the vacancy rates and the rental growth. So a sudden drop in rental vacancies, squeezing tenants, rental growth precedes capital growth. So how it would go would be low vacancy rates, low vacancy, means rising rents, yield improvement, investor demand, and then that will come into capital growth. So it sort of flows on basically that way. Building approvals versus commencements. Compare council approvals against builds. If approvals drop while the population climbs, shortage pushes values up. So we always check building approvals and what there is in there. So and infrastructure capital injections track the multi-million-dollar spending on hospitals, transport, commercial hubs that drives population. And maybe another what am I calling it? Population growth. So definitely, we always look at metrics and what area, what state's going to have the biggest population growth and, all of that kind of stuff. There's 105 metrics, but these are sort of the main ones. And years to own is also a very big one. So the affordability index is another one that we track as well. So when we track them, we spend thousands every month on using these programs that track all of that. So we have HTag, Microburb, Stash Property, Archie Star, Price Finder, Hotspotting, and also other data sources. We focus on lead indicators, and I think there's even over 105 data points, but there's and we don't just rely on the one set of data, we cross-reference it to other sets of data as well. So just because, there's a lot. So, okay. Property ready is the next one. So once we're ready to find a property, a lot of investors will buy with emotion and, I don't like that kitchen or I don't like the color of that or, and so you've got to avoid the aesthetic trap. So when you're looking at for an investment, it's all about the numbers and that's all it's about. Obviously, we want to make sure that it's structurally sound. There's no, too much maintenance or anything like that. But you know, it's not how it's styled. It's not that it's fresh paint. It's looking at it. How, is it structurally okay? Is there easements on the property? Is there, you know, flood, fire, all the due diligence that you want to do for it? You want to make sure that, you know, it's structurally and legally flawless before you sign the contract. I mean, obviously you can get a building pest afterwards, but when you're going through, like, are you checking under the sink to see if it's leaking? You know, have you looked into the meter box to see if electricity's been updated? There's so much that you can look at in a property that's not actually, oh, I love that couch in here, and you know the color's nice. You can always change the color, but it is about the numbers as well. So how much rent is it achieving to how much, you know, how much is it going to cost you? And like Louisa said, you know, how is the strata fees? Is there a sinking fund? When we're looking at it, you know, we read the minutes of the last strata. There's by law, there's a 10-year forecast of forecasted works for a strata. How much is in the sinking fund and how much is in the forecasted works? Is there enough money in the sinking fund to do the forecasted works? Or you know, we've rejected properties where, you know, the whole building's in financial trouble, and you know the new owners would have had to have put in thousands upon thousands of special, you know, sinking fund levies to pay the upcoming work. So you've got to make sure that even the asset is financially stable if it's a strata. Okay, which is, like I said, check the invisible. Sorry, I probably jumped ahead. So there's restrictive overlays, a hidden easement, zoning rules that could kill a renovation or a subdivision. So, you know, I spoke to someone the other day and they said that they had a client, this is a mortgage broker, and they had a client that thought they bought somewhere and they thought that it was subdividable, but it actually wasn't. So you know, you've got to check those things. Environmental infrastructure risks, tracking major flight paths, bushfire maps, overhead flood zones. We even look at noise maps and how noisy that property is, identifying hidden upcoming, you know, council zoning, public housing. There's so much that we research, and we have a whole massive list of due diligence items that we put each property through. Subsurface structural and integrity, um, inspecting title boundaries to prevent costly encroachment disputes, deploying independent checks for pipe deterioration. I didn't even say that word. Structural defects or rising damp. So, what in essence, a property is like an iceberg. The styling, the paint, the bench tops are just 10% floating above the surface. True property due diligence is about diving underwater and inspecting the 90% you can't see, because it's the 90% hidden that can sink your entire portfolio. So we want to make sure that we're not buying a property that we're going to have to sink thousands into, and you know, it's structurally sound and you're buying what you think you're buying. Okay, the other thing is relying on online listings. So just like there's a hidden job market, there's also a hidden off-market properties market. So you can, properties that are sold discreetly, never making it onto major real estate websites. This means a substantial portion of available homes are completely invisible to buyers that only search on real estate and domain. So we access, I think 60% of our listings we purchase off market for our customers. So we have relationships with agents. We go direct to them. We might, you know, today we emailed out a client's brief to 700 agents. So, you know, asking for off market and pre-market properties. So our job is to get into those properties before anyone else sees them and buy them before anyone sees them. It takes competition. And why people sell off market is because, one, it might be tenanted already and the tenants aren't going to present it nicely, and they're going to be difficult trying to get people through. People don't want to pay for marketing costs, and you know, there's all different reasons why a property will go off market, or they just want some privacy and they don't want 100 people traipsing through their house every day, or every weekend. So there is an off market property listing, and you know, you've got to do your best to get to those properties, because it will, you know, you have less competition and you can get in first before anyone else knows it's out there.
Can I just add something there? I'm gonna butt in. For me, that is one of the biggest benefits of a buyer's agent is the off-market opportunities. And as a broker, that's where we really see the people that are using buyer's agents getting good bargains. So like they might be paying the fee for a buyer's agent, but we go, oh, look what the buyer's agent got that property for. Like we've seen people save hundreds of thousands. I'm not talking $5,000, $10,000 a year. So, you know, that's why I use buyer's agents, because it's like, well, today I'm too busy. I don't do it day in, day out as much as I think I know a lot about property. But those off the market opportunities, the relationships you have that we can't get as a normal person, we can't build those relationships. So we don't get those opportunities. So for me, it's one of the biggest advantages and the biggest value add.
Yeah, it is great. And it is building up, years of relationships. Like I had an agent call me today and he's like, Karen, I've got this rooming house. He said, it's set up, it's getting $1,700 a week in rent. Like I just, it's only going to cost you 900 to 1 million it's priced at. And he said, have you got anyone for it? And he goes, they want to sell off market because they don't want to freak out all the rooming tenants. And I'm like, okay, send it to me and I'll see what I'll find someone for you, sort of thing. So, and I'm a repeat customer and I'm back every week with another client. And, so they get me through these clients, they get me through these houses and they just, I have a whole list of off markets. So it's, and I can't even utilize all of them. So it's just about building relationships. You can
Yeah.
log into into the realestate.com's website. I mean, not real estate, the actual agent's website. So you can go to the local and they will sometimes list their off markets there, but then not even all of them are listed there. Like there's some exclusively. Like I have some agents getting me through as they're signing with the vendor, where they're signing their sales agreement. They said, I've just brought a buyer's agent with me today because I know what you've got is what she's looking for. So I'm buying the house as he's signing the contract with the vendor. So, it is. And I mean, not all off markets are cheaper as well. I do want to point that
Yeah.
out.
Yeah.
You can negotiate better because you don't have that competition or anyone else driving that price up, and it's all about comparable sales. But they're not always cheaper, but there is a lot of advantage to them. Yes. And they're not always the better property. Sometimes they're off market because they're, for a word, not in the best condition. So yeah, some of them aren't great. So just because it's off market doesn't mean it's, buyable. So if you've been looking for a property for a while, you'll be pleased to know, or maybe not pleased to know, but it takes on average, the average buyer takes 9 months to purchase a property. So as if you use a buyer's agent, our average is 4 to 6 weeks. I've done 2 days, I've done 5 days, and I've done 3 months. So I think 4 to 6 weeks is kind of in there. So basically if you're a first homeowner, you've got 9 months of waiting till you can find a property and buy a property. If we're doing it worst case scenario in 3 months, there's 3 months of 6 months of rent you've saved, what, $30,000 plus, you're getting in today's prices where instead of 9 months time prices, and you're actually growing your equity from the day that you get into yeah, till, if you can get in sooner, the better, basically. But a lot of people, there's a lot of reasons why it takes so long: decision fatigue, missed opportunities, rising prices, rising interest rates, budgets, and just not being able to get a deal done. I had a client come to me and he had been looking for 5 years pre-COVID. And what he could have bought 5 years ago to what he could buy today was ridiculously different. And I had him under contract within 5 days. So he was just like, wow, where have you? I wish I'd known about you 5 years ago. So it's sometimes it's hard. We do have a negotiation only service as well if you just find like you can't get that deal done. But yeah, it is hard. Stock is down across Australia. But we are at the moment turning into a bit of a buyer's market, which is nice. So if you're interested, the ways that we help our customers, we have a few different services. Like I just said, we have a negotiation only and auction bidding service. And we do all the due diligence on the property as well to make sure you're buying the right asset and the correct asset and making sure it's done. We have the full done for you service, which is a full buyer's agent service. So say if it was an investment, I would be I'll go from where to buy to handing over a property manager. Like I'll interview a property manager for you, handing the property manager a pair of keys, and I would negotiate to use the sales photos as part of to advertise for rent. I'd start I would negotiate to be able to advertise once you're unconditional. And so hopefully by the day of settlement, we'd have a team of people lined up ready to inspect your property for rent. So that's a full done. And then if it's an owner occupier, obviously I do that without the property manager. So if it's a done with you service, we have the property navigator program. So this is for people that can't afford a full buyer's agent service. And what it is, it's you're navigating and you're in the driver's seat and we're navigating. Sorry, I got that mixed up. So basically we have a 12-week program that every week it will show you something how to talk to agents, how to submit an offer, how to find off markets, how to do the due diligence, how to do everything we do but using free tools. And you get a free Monday board. All our clients get a board so they can see what we're assessing. You get WhatsApp group chat during business hours, text messages with us. You get 3 SOS calls. And the great thing about it is I'll come in and negotiate the deal for you. So I'll make sure that you're paying a good price and you're getting the deal across the line. So it's strategy, mentoring, support. And we did it over 12 weeks because that's how long your pre-approval takes. And we aim to get you into a property within those 12 weeks. And then we have our other service, which is a property playbook. So this is a wealth retirement building tool. A lot of people are collecting properties and building a property portfolio, but they've got no goals in mind or nothing, what they want to do. So they would say, you would come to me and say, Karen, I want to retire on $150,000 passive income and a year, and I want to retire at the age of 65. So what the tool is you get lifetime access to this online tool, and we pop in where you're at now, if you've got a house or if you haven't got a house, or where you're at, and then you put in all your income and everything, and then we reverse engineer a model to how to get to where you want to get to. So it might be that you have to buy 2 houses in 2026 for $600,000. They're typically 6% yield, and they historically has grown 6% in the last 10 years, just numbers making up out of my head. And then in 2028, that will unlock another house that you can get, and then you can buy another house. And then so basically we'll reverse engineer a property plan for you that you can get to, so you can get to that passive income once you retire. And it takes into life events like marriages, births, new cars, holidays, and you can scenario test. So say you're sitting on interest only at the moment, and you know that you're coming up that you're going to have to switch to principal and interest. You can put that in and you can scenario test out, like, what's it going to look like? Or if you're on principal and interest and you want to go to interest only, like, if I look at that, does that free up my cash flow? What does that do for my borrowing? Does that open up another house and strategy for me? So that's the sort of the different ways and that's a standalone product. You don't have to use my buyer's agency services for that. You can just use that platform. Um, so when we work with you, that's the Monday board I was telling you about. So with the navigator, you get access to a board like this, and our clients do. So you get a login to a page with us, and you can see all the houses that we're basically assessing, and you can see sort of the steps, that you can see the due diligence items, like there'll be a drop down and there'll be due diligence, and so you can see everything that we're doing, and you can leave comments in real time as well. So basically you're across everything we're doing as we're doing it, so it's real-time data. And I think I've just told you all of these 3 things. So that's a property navigator. Sorry, I should have jumped ahead. The playbook is the retirement planning strategy, and this is our last slide. How do we go?
There you go. Very good. So I think we've got a couple of questions. There's a chat box, everyone, at the bottom. If you've got a question, pop your question in the chat box. But there are 2 questions there.
Okay, so when should an investor start thinking about the second property? How do I get a portfolio fast, and I can do this? So Louisa, you can answer the financial part of that, and I can answer.
Yeah, I mean, it's I say to your income can only get you so far, but it depends on. I mean, depends on your debt servicing, how far we can get you. There's no reason if you've got the capacity to borrow, why we couldn't, you can buy six in a year. Whether I wouldn't recommend that, but it just depends on what your income is, how much rent you're getting for your property, what your expenses are. Depends how much we can get you. If
But
somebody is wanted to buy a few quickly, we can run that all at once. So if you want to say, look, I do want to buy three in the next 12 months, we can run that scenario at the same time for you. It's not a problem.
And what people have, I think, is what I like to call lazy equity. So you might have a home loan at home, or you might have an investment property, and you say you're just for round numbers, you've got $500,000 owing on your loan, and the property's worth $1 million. So, Louisa, can they borrow? What can they borrow? If so,
Yeah, we
there's
call
five,
it dead equity. You call it
yeah, it's
lazy
lazy or
equity.
dead.
We call it dead
We don't want
equity.
it to be
But
dead. We just want it
yeah,
to be lazy. We want you to get
yeah.
everything again. So
But
you
look, you
borrow.
can borrow back up to 80, 90% with the banks.
You can take that
Depends.
500,000 and borrow 80% of it to,
So you would borrow your deposit against your owner occupied property and your fees and your charges and everything. So you generally 20% and your fees against your owner occupied on a separate mortgage split, and then you'll borrow 80% against the investment property. Normally, that's the way people would do it.
yeah. So if you do have equity in your home, go see Louisa and she can work out whether you can tap into that to start your next property. And if you want to go build a portfolio fast, you can pretty much, we can buy you in an area like, so when my question was, when do you want to get equity out, which is what we were just talking about, is it 1 to 2 years, 2 to 3 years, 4 years? So if you want to go fast, we'd be buying in more of a hot spot. So it will have that quick growth, so then we can go again. So that would be how we would do that. I hope that answers the question. Um,
How
how
do I know for buying a name and a trust business structure, as I don't know how to decide? That's accountant's advice.
Yeah, yeah. Go
So
to your accountant, because what it would be a different advice for every single person here, depending on what you might have your own business, you might be a PAYG. They need to know, and they will give you advice on that. The other thing also is there's superannuation that you could tap into as well. If you've got at least 150, 200,000 in your super, you can go to Louisa and ask for a loan. And that doesn't affect your borrowing capacity. So a lot of my clients get a house in their super and a house out of their super at the same time, because the super, they treat it like a different entity. They
yeah,
don't, it doesn't affect you, it doesn't cap you out, and it doesn't affect your borrowing capacity. So you can actually buy a house in your super, and then you don't pay capital gains tax when you sell it. So
we're actually doing more self-managed super funds right now than
yeah,
we've ever done. And
yeah.
that's mainly
That's
because
it.
interest rates are higher. People are struggling to buy property in their own names because they're maxed out. So they're going into self-managed super. But yeah, it's a
The budget.
great way to buy property.
Yeah, and the budget as well. So,
Yeah.
because nothing was affected with the budget. So
Yeah,
everyone,
the budget's going to push people more into that.
yeah, so you don't pay any capital gains tax if you sell that property while you retire. But if you buy something in your super, you can't buy anything to renovate. So you can only sort of do up what's existing under the existing structure. You can't put a granny on it, or a granny flat or anything like that. So you have to sort of select a different type of asset, if that makes sense. Um, If you are buying to occupy, is there an ideal timing in your market environment clock? No. I think that if you're buying to occupy, you obviously want to live where you want to live. I can run reports, say you want to live in a region of, I can run reports of different suburbs and tell you which is the better suburb that's going to do the best and do the well to get more growth out of your property. But the clock is really, I mean, unless you're prepared to move to, Melbourne or Tasmania or wherever you're prepared to move to, it doesn't make too much. So sorry, did I even read that question out so people know what I'm saying? If you are buying to occupy, is there an ideal timing in the market to your environmental clock? So no. But saying that, in the areas that you're thinking about, on the suburbs you're thinking about, I can definitely run reports and tell you which is going to be the better performing area out of the areas that you're considering. And the next question is, if I was interested to hear briefly re-affordability factor amongst 105 point factors, do you mean the suburbs you intend to buy in and the group of prospective buyers that might also be interested in the same area? Hang on, sorry. If I was interested to hear briefly re-affordability factor, most be interested.
Do you mean the suburb we intend to buy in and the group of prospective buyers that might be interested in the same area?
Is it Jana? Are you there? Do you want to put your microphone on and ask me that question?
Hi, Karen, can you hear me?
Yes, I can.
Okay.
Sorry. Sorry.
Sorry. So, you know how you said you only covered four because there was about 105 points and you wouldn't cover everything? And I think one of them you pointed out was affordability.
Yes.
Yes. Could you elaborate on that point a little bit? Like I was just wondering what that point means.
Yeah. So
Thank you.
basically, if a suburb is unaffordable to people that live in it, that's not a good thing. So there's a years to own. So we basically kind of like, a 30 year to own. Like if it's like 48, 50 years to own, it's unaffordable for the people that live there. So it's not going to it's not going to increase in value because a lot of the owner occupiers there won't be able to afford to live in it. They'll move out, and it will. So then the suburb will become stagnant. So we wanted the suburb to be affordable for the people that live there. So the prices are pretty much already inflated too much. So in a suburb where prices are inflated too much, there's no buying. If that makes sense. Does that make sense?
Yep. Thank you. Thank you so much.
I love the next question. We're being asked this a lot. With the recent changes to negative gearing, do you think that the new homes being built, purchase prices have been increased? Would you still buy existing property?
Yeah, I would. I'm not a big fan of the new builds. I actually had two new builds that I was actually buying. They'd just been built for clients in Melbourne. And this is a big tip as well. Always get a building inspection, even on a new build. So I got a building inspection done, and the building inspector he phoned me up and he said, "Karen, don't walk, run." He said that all the roof trusses are bad, the roof plumbing's going in the wrong direction, and the real estate agent and the developer tried to bribe him to say it was compliant, and so he just said, run as fast as you can. Why I don't like new builds, if you're buying in one of those big complexes, the housing complexes that are massive, and you're buying a new house and land package, everyone's buying at the same time, everyone's building at the same time, everyone's renting at the same time. And then when you go to sell it, you're, a couple of years down the track, if you wanted to sell it down a couple of years down the track, the builder's still there building another new home, and it's going to be at the same price as what you want to sell for. So why is someone going to buy your 3-year-old home when they can buy this shiny new object there? And there's no growth in it because the builder's taken all the capital growth, and you're just not going to get it into that market. So I would definitely buy existing properties over new builds any day of the week. I hope that answers that.
Yeah, I think sadly there will be a lot of investors not thinking it through and automatically just running for new build properties now.
Yeah.
And I think as brokers we'll start to see, I think that, because when that happens, the builders are going to put the prices up, they're going to inflate them. And then we're going to start having valuation issues where the banks go, actually, that's been overinflated. We're not going to lend to that property price. So we'll start having valuation issues. We'll have shortfalls on valuations. It's going to cause all sorts of
And then
problems.
there's shoddy builders. The Joe and Jack down the road thinks, oh yeah, I'll build a couple of houses and turn them out. There's no regulations. And there's no infrastructure as well. So what the government has done, they've got the first homeowners have to go for new builds to get their grant. They've got the downsizers. If they want a grant, they have to go for new builds. They've got the overseas people have to go for new builds, and now they want the investors to buy for new builds. So you're all competing in the same market, but there's no water, there's no infrastructure, there's no plumbing. Like even say in South Australia, they can't even build anything because there's no infrastructure in place. Like they can say, "Oh, we'll build all these new homes," but there's no infrastructure. There's just they just haven't thought it through.
And I think, you know, we see, because we get to see the majority of the the inspection reports for the bank's values going out. You know, the bank does the valuation, not us, and it's their valuation, not ours. But the majority of them let us see them. Like with the new builds, they all have issues. They've all got some sort of issues. And what we've seen with our clients that have been buying apartments and things, the number of apartments that are like 5 years old, water ingress issues. I've got one client's got 2 apartments at the minute, one in Brisbane, one in Perth. Both apartments got water ingress issues. One's having to do a special levy. That's why she's come to us. We're having to borrow money to get the special levy. So you've just got to really be careful of where you go. I've got a real concept. Obviously, I don't agree with the majority of this budget, and I'm not going to go on about that. But it's yeah, I think we're just you know, we're going to start seeing all sorts of problems if everybody starts running to new builds, not realizing that they're paying overpriced and all the rest of it.
100%, but always do your due diligence. 100% get a building and pest control.
Yeah.
The other one little tidbit I'd probably throw in, if you have to go for apartments, if that's in your budget, don't go for the high-rise apartments, go for the block of 6 granny flats. So yeah, it's always about that low-rise block of 6 grannies. Like a high-rise one, they'll have strata, there might be lifts, pools, jacuzzis, that's going to need maintenance, and 10 years down the track, it's going to cost you a fortune. And basically the land is the value. So if you're buying a block in a block of 4 or 6 grannies on the ground, that land that those granny flats sit on is divided by those 6 units or the 4 units or whatever there is. So you're always going to get more capital value in that. If you buy in one of those high rise and there's 1,000 apartments or 100 apartments, the land that it sits on is divided by the 100 of you. So the building's always going to get old and shoddy in any building. It's the land value that's going to, is going to increase. So, always go those low rise block of 6 as an investment over a high rise every day of the week.
Yeah. All right, any more questions, anybody? We're good to go. All right, well, we've been on 55 minutes, covered a lot there, Karen.
Okay,
Thank you very much for your time, Karen, to educate everybody and to get everybody thinking. Obviously, if anybody does want the numbers running to see if anything's possible, give us a buzz. And if you are looking for a buyer's agent, you know where to find Karen. Her contact details are there. But thank you for joining us tonight. It's been a good 1 hour. I've enjoyed that. Thank you, Karen.
having me, Louisa. I appreciate it. So
Okay, thank you. Bye, everybody.